Has overregulation been killing the U.S. stock market? By www.profitableinvestingtips.com. In the last 40 years, the market capitalization of all stocks listed on U.S. exchanges has risen from $704 billion to $27 trillion. 40 years ago, there were nearly 5,000 stocks listed on U.S. exchanges, and that rose to about 7,000 by 20 years ago. Today, there are 3,600 listed companies in U.S. markets. How is it that while market cap has gone up 40-fold, the number of listed stocks has fallen by a third? Business Insider discusses the case of the missing U.S. stocks. The U.S. seems to be the only developed country that lost so many stocks. Most other countries actually gained around 50%. This matters because the U.S. stock market accounts for a little over half of the entire global equity market, meaning a huge and growing number of investors and fund managers now have fewer options to choose from than they did only a couple of decades ago. The article cites 3 reasons for a decline in the number of listed U.S. stocks. 1. Mergers and acquisitions. 2. Growth of private capital investment. 3. Increased number of federal regulations. M&A is easy. 2 companies become one in a takeover, and private capital has allowed many companies to avoid going public or put off their IPO until they have grown significantly. The article notes that Apple went public 4 years after starting out in Jobs' garage, while today the average age of a tech company at IPO is 11 years. This is a function of available private capital, but also increased costs associated with getting listed on a stock exchange. The end result is that only large, well-funded companies have the wherewithal to do an IPO. However, regulation, according to Business Insider, is the real culprit. Sarbanes-Oxley Act. In 2002, in the wake of the Enron and WorldCom scandals, Congress passed the Sarbanes-Oxley Act. Investopedia explains. The SOX Act mandated strict reforms to improve financial disclosures from corporations and prevent accounting fraud. The rules and enforcement policies outlined by the SOX Act amend or supplement existing legislation dealing with security regulations. The 2 key provisions of the Sarbanes-Oxley Act are Section 302 and Section 404. Section 302 is a mandate that requires senior management to certify the accuracy of the reported financial statement. Section 404 is a requirement that management and auditors establish internal controls and reporting methods on the adequacy of those controls. Section 404 has very costly implications for publicly traded companies, as it is expensive to establish and maintain the required internal controls. The bottom line regarding this law is that it is proportionately more expensive for small startups than for larger companies, and thus inhibits the growth of the sort of companies that feed into the market to make it grow. DoddFrank Wall Street Reform Act. In the wake of the 2008 market crash and Great Recession, Congress enacted another law to clean up bank lending. Unfortunately, the victims of the law have been small companies. The Federal Reserve Bank of Dallas writes that small business lending languishes as community banking weakens. Community banks are key providers of loans to small businesses, which are important contributors to the local economy and international trade. While regulatory burden on small banks and its impact on lending has received attention, it is difficult to isolate the most significant driver of sluggish small business lending. Business Insider writes that the answer is easy. Banks simply don't want to deal with smaller, less than $250,000 loans because the cost of compliance with Dodd-Frank is the same for all loans, large or small. The end result of all this is a lot fewer but much larger publicly traded companies. For more insights and useful information about investments and investing, visit www.profitableinvestingtips.com.